Hi everyone. The most common question that I receive from most people when I talk about investing is, "Hey, market, is it up or down now? Is it a right time to invest in the market? Is it too value? Is it too priced, overpriced, or is it underpriced? Uh, what is the thought about inflation? Will the market fall another? Will it crash near term due to the war around, due to the pandemic?" So people are all the time thinking about timing the market, making the entry point in such a way that the timing becomes perfect. But unfortunately, that doesn't work. Timing is a futile exercise. Let me vindicate that point by bringing you a real good story of five characters that existed in the markets. Now, this is not my own. This is a study done by Charles Schwab investment firm, who went ahead and did a hypothetical study of five characters. These five characters are Peter Perfect, Ashley Action, Matthew Monthly, Rossi Rotten, and Larry Linger. So these are the five characters. Their surnames say something. So check it out. Now, what is the study did? What did they do? Each of these characters received $2,000 at the beginning of every year for 20 years continuously, and they left the money in the stock market as represented by S&P 500 index. So every character received $2,000 for 20 years, and these $2,000 were invested in the market, assuming it is invested in S&P 500 index. There is no other stocks or anything involved here. Now, the why the study is interesting is, you can see the difference in performance. One of the character, which is Peter Perfect, as the name says, he was a perfect timer. He had an incredible skill to time the market and was able to place $2,000 into the market at every year at the lowest closing point of the index. Now that was Peter Perfect. But then there is Ashley Action, who just took a simple step. As soon as Ashley received the money consistently every year, she received the cash. She invested $2,000 in the market in the first trading day of the year, immaterially, right? And she consistently did that. Now then there is third, Matthew Monthly, who divided his annual income into 12 months, so into 12 parts, and he invested equal portions in across each month every year. So if he received $2,000 divided by 12, approximately $120, and invested that in the S&P 500 index equally every month. Now Rossi Rotten, who had incredibly poor timing, opposite of Peter Perfect. So Rossi, she really sucked at the timing. So she had to invest always at the bottommost, at the peakmost value of the market, which is whenever the index was trading at the peak value, she had to invest in that peak value during that year. And she did this consistently across 20 years at the peak value of every year. And finally, we have Larry Linger, who lingers around, who waits around, trying to time the market, but ends up not investing any money in the market, and left his money in the cash investments like treasury bills as a proxy, every year, and never got into the S&P 500 index into investing. The results were astonishing. At the end of 20 years, when the study revealed that the perfect timer, Peter, ended up having $151,000 at the end of 20 years. Ashley, who invested immediately, ended up the second highest, which is 135K, and the third highest was one who did dollar cost averaging, that is like equally across months throughout the year for 20 years. So that was done by Matthew, and Matthew ended up with $134,000, slightly lesser than Ashley, and bad timer Rossi ended up with 121K, and finally, one who never invested, that is Larry, who lingered around, with due to analysis paralysis and the fear of investing, stayed in cash and ended up with just $44,000. So look at the stark difference that is there out there between one who invested immediately or dollar cost averaged it, who is so closer to the perfect timer, whereas with respect to the one who held up in cash, ended up with such a meager returns. So this indicates a point that do not there is not much point in timing the market in the long term. Yes, in the short term, over a 1 year, 3 year, even up to 5 year period, there is an impact. If you can time the market, that's better. But over a long term, if you are looking at 20 years, anything above 10-15 years, there is little difference between timing the market and just investing whenever we have the cash. Now, Fidelity did a similar study that showed $10,000 hypothetically invested in 1980. They did a study between 1980 and 2020 to see how that $10,000 would have performed over the 40-year period. Now, the interesting fact here is, again, if you see a person who was invested, stayed invested in all the days between the 40 years, outperformed anybody else. Like, a person with 10k at the starting of 1980 would have ended up at 697k, multiplying it almost 70 times. So at the end of 40 years, right now, if the person missed best 5 days, just the best 5 days, would have ended up at 432k. So look at the difference. I mean, it is almost a third of the returns has been wiped out if the person missed just 5 best days in 40-year period. Now that is something really difficult to time it, right? So if you had just missed 5 days, it's done. Now if you had missed 10 days out of 40 years, your return is 50% down, 384k. And if you had missed 1 month out of 40 years, just 1 month out of 40 years, whatever reason be, you would have ended up at 115k. That is like 70% less. And if you miss the 50 days, that is 2 months out of 40 years, you would have ended up at 48k. So this is basically the point I'm trying to make is trying to time the market is a futile exercise. The best alternative, the best way to invest is to stay invested through the course, thick and thin, no matter what. And if you get new money, just go and buy the stock that you already have or buy the index what you have. Just keep doing that. This way you don't need to time the market. You don't have to worry about the market valuations. You don't have to break your head whether a war is going to disturb or the market is going to crash, whether it crashes, whether it is going up. Whereas in bull market, bear market, just keep buying and that keeps going up. I mean, that is a proven economical theory. Now these are applicable only to the some of the nations, some of the countries like United States. It is the case in China, it's the case in India. Some of the countries are have a structural bull market, structural growth story that is going on. So if you just place the investments in the index funds, that would suffice. Or if you have a geographically diversified asset classes and keep investing, that would suffice instead of timing the market. So going forward, please don't break your head in terms of whether we should time it now, whether should invest it now, etc. Instead, just keep investing over a long period of time. You'll be astounded by the way compounding works. Wanted to bring this to your attention. Thanks for staying with me. Signing off, Sandeep, Anand.